All right. Well, hello, everybody. Joe Lucey here, President of Secured Retirement Financial, with what's going to be a weekly update on the markets, coronavirus, staying at home, and weathering the storm here. So today's this webinar is going to last, I don't know, 10 or 15 minutes. We're going to try to keep it fairly short. The idea is just to kind of give you some useful information that you can use to optimize what's going on or to protect yourself in your retirement and what have you. So keep in mind that the attorneys asked that I share with you this quick disclosure. Says that I'm not a member of the government. I'm not a CPA. I'm not I am an investment advisor, and I'm not an attorney, but basically we are sharing this with you to try to keep you with some up-to-date type information around what's going on here. As you know, the markets are hitting lows. The market is at a low right now that's we haven't seen since 2016. So a lot of scary stuff going on. And what are we going to do about it? Well, there are some bright points here. One of the good things that's out there is that they did announce here recently that the Internal Revenue Service, everything's going to be pushing off our taxes, both the taxes that need to be paid and the filing. So there's going to be a little bit there. We're hoping that the Senate passes something here today regarding a stimulus package, what they think is going to really help matters here. And I'm going to spend a little bit of time on this presentation here today talking about, where do we think things are going from here and what have you. A lot of look forward statements. So understand that what we're talking about is nothing should be taken as a guarantee or such. We're just trying to figure out where to go to from here and if there are any opportunities. So here's where we're at, 350,000 worldwide cases. Last Wednesday when we did another webinar, we were at just under 200. So big increases. Now, what does that mean for us? So we get really, one thing to take from this is understand that the numbers that are showing here are actual just numbers. They aren't as a percentage of the population. So I've seen some things online, folks saying that the growth that we're seeing in the US is so much faster than what they were seeing in Italy and things like that. The reality is that if you take the fact that the United States is 5 times larger than Italy and such, us in our cases, number one, we're also doing a lot more testing than I think they were early on. I think that as a percentage, we're growing at a lower rate. That means that the social distancing and such that we're doing, I'm optimistic that that's going to be very beneficial and that we're going to go through this a little bit better. Of course, I don't know, and neither does anybody else. It sounds like this week is going to be a little scary as far as the amount of growth, and even next week might be even worse. Heard rumors that there are some large companies that are now saying that they're asking their employees not to return until May 1st. What does that mean? Well, keep in mind, the stock market is a forward indicator. The markets will probably start to go up prior to the contagion, the coronavirus getting to its worst point. So means that maybe we want to take that into fact and understand that even if the markets are going to get a little bit more rocky this week, we could see a bottom, and I'm optimistic we're going to see that bottom probably in the next week or two. But again, I don't know, and neither does anybody else. We can look at history, black swan events that we've had occur in the past. The coronavirus here, we're down and it says 30%. I think this piece here from New York Life is actually a little bit dated. The global financial crisis, 2008, we were peak to bottom about 56% down. And of course, we recovered from that. There's some other smaller ones in here. And such 2000, this is 1997. So 2000 is in, this is 2000, 2001 when we were down here. So what is this? What is the purpose of this? Well, the purpose of this is to show you that the markets do tend to come up. If we're going to sell out of the markets here today, we got to be right twice. We got to be right by selling our investments where they're at, and that the markets actually do continue to go lower. Number two, we got to be right that we're buying at a lower price before they go up. And again, as understanding that the markets tend to be forward-looking indicators means that that's going to be a little harder to do. This is through March 18th, however, of 2020. What about other history? Let's look back. And basically, this is a chart that we've got that says not only do the markets tend to go up, but actually the worse that they go down. English teachers probably don't like the way I said that, but the more they go down, the bigger the growth is in the near term. So when we go back to 1929, this top row here, where there was 86%, almost 90% of the market's value was taken away, the following 12 months after it hit its bottom, it was up 162%. The risk of missing this, if you are still in the markets and not getting that kind of growth after we've bottomed out, is enormous. Go back to 2007, 2008, this next row down, 56%. We were up 53% now. A 53% return in 1 year doesn't get us back to break even. It doesn't mean that we're going to go back to where we were here a few weeks ago. But you looking out a little bit further, go to 3 years and 5 years, you can see that there's a tremendous amount of risk of missing a recovery in the market by being wrong here. 2000, 2002, still a memory for many of us, down 50%, up 24 the first year, 3 years later, up 59. I just really think that if we're going to see a bottom here, I think it's going to happen in the next couple weeks. And if we aren't astute enough or quick enough to get back in, we could miss a tremendous amount of upside. So our recommendation for most of our clients, unfortunately, we're going to have to stay the course here. I think that there's probably more. There's going to be some ugly things in there, but I think the markets have already kind of factored that in. So if the state of Minnesota here decides to tell us that we have to remain in place, we can't leave our homes at all, that would be negative news, but I think the markets have already accounted for that. Some of the more positive things would be to see less growth out of the coronavirus or potentially some cures or some treatments and what have you, and maybe things just getting better. You know, by the time we are told we can go back to the workplace, or the time we're told that we can go and sit down for dinner someplace, the markets are already going to probably be higher. My assumption is than they are today. Of course, I don't know, but I think they'll be higher than they are today, and I think it's very likely that they could be quite a bit higher when we start to miss these returns. So something to keep in mind. What are the opportunities we have? One is repositioning our market investments. Let's take a look at your asset allocation. Are you nervous that the market's going to go lower? There are ways that we can protect the principal and still give you some of the recovery without just going to cash. So if that's something you're concerned with, if you think that the markets are going to go lower, let's discuss some investment opportunities that can allow you to get some of the returns of the market if we do see some of these tremendous returns I was just showing, without taking more downside risk. On the other hand, maybe it makes sense to start to reposition some of those protected assets you have and start to either dollar cost average or what have you back into the market. Repositioning bonds with historic lows on the bond rates. While we might see a little bit less or see some more upside to bonds as interest rates go lower, bond prices go higher. While we might see some upside in the near term, I think longer term, when I'm start looking out 12 months, 36 months, I think that bond returns are going to have to suffer. We're going to start to see some interest rates going higher. Maybe some of those bonds and those conservative portfolios are all-weather portfolio, which has done tremendous throughout all of this. Take some of the bonds off the table. We should be talking about that if you are looking for ways to maybe capitalize on the stuff that's going on here. Roth conversions. We've been doing a tremendous amount of Roth conversions. In fact, we are getting probably 3 to 4 to 1 phone calls right now in the office here about folks saying, can I start to move some of this tax disadvantaged money, my IRAs, my 401k? How do I get that money that I'm going to be taxed on over to a tax-free or tax-advantaged account like a Roth IRA to take advantage of this. We're getting far more of those than we are folks saying, hey, I can't take this anymore. I need to get out. And I think part of that is because of the planning that we've done up to this point, making sure that we are not in a position where we're going to be forced to take money out of a market that's been clobbered. It's down 30% or better right now. Required minimum distributions. If you are in a position right now that you have a required distribution, you're 70 and a half last year, and have started taking your RMDs. If you don't have a protected place to take those RMDs like most of our clients do, maybe it does make sense. Let's start to discuss whether or not that would make sense if we should take those RMDs now. If the markets, if you're in the position that you think markets are going to go a lot lower, you definitely want to take them out now because you're only, the calculation was based on December 31st of last year's numbers. It's a percentage based on that number. The account's down, you're taking out a higher percentage. If you don't have a protected place like most of our clients do where we can take this money, let's talk about what we should be doing as far as considering whether we should take it now or do we wait and see if we can get a little recovery between now and December. Tax loss harvesting. I know that a lot of families have been sitting on investments that were hard to sell. The capital gains, if you have an investment account that was up, if you had a stock that was up 300, 400, 500%, to sell that, you were paying a lot of capital gains. Some of that's come down. So maybe it's an opportunity to better diversify those accounts, look at other opportunities, take some tax loss harvesting and offset some of those other gains. Keep in mind, the IRS says that if I sell something at a loss, I got to wait. There's a 30-day window before or after the sell that I have to do if I'm going to recognize that loss. However, if I just want to reset my cost basis, if I have a stock that started here that's now up here, I can sell it up here and turn around and buy it back a minute or two later. I reset my cost basis. We have another 365 days. We have to wait for long-term gains, but it might allow us to kind of take advantage of some of this market volatility to kind of reset some cost basis, which in the long term can help you out tax-wise. It's a lot of what we do here at Secured Retirement Financial. If you're working with us, you already know that. It's not just about money management here. It's about looking for opportunities, and a tax loss harvesting opportunity might be perfect for you. If you are if you have annuities, if you have indexed annuities or fixed annuities, or even a variable annuity, maybe taking some of that money out now, the 10% annuity-free withdrawal makes some sense. Take that money out of a protected account like the indexed annuity and reposition that into the stock market. Start the dollar cost average down here and see how that would work for you. So I guess the takeaway here is understand that I don't know where the markets are going. They could very well be going lower in the near term, but I think longer term, I think there's an awful lot of opportunity, and that's what we've been spending a lot of time helping families locate and do. Now, if you're a client of ours, I encourage you to reach out to us. We're trying to reach out and connect with everybody on a proactive basis, but it's hard for us to get through all of our clients. So give us a call if you've got concerns. Let's have that discussion. If you are not a client of ours, the phones are open to give us a call. We'd love to spend some time. We're putting together what we call 15-minute emergency phone reviews. It's about helping families. Whenever there's a crisis, it's about helping people out. And if you have some concerns, if you're not sleeping well at night, if you aren't sure if your planning's in place, you want just a second opinion, we're available for that. Couple other opportunities, I guess, going back to my slide here. Keep in mind, now is a good time to be supporting your small businesses. Some of you maybe have kids that were in Little League, and these small businesses are kind of the backbone. 50% of all employees are hired by a small business. Back in the day, the Little Leaguers were maybe getting some sponsorship by some of those small businesses. Now's a great time to be paying it back. Consider calling a restaurant, picking up some to-go food or what have you, helping out the small businesses out there. Keep in mind, continue to wash your hands, stay healthy. And if you do have concerns, give us a call. How should you do that? Number one, our office number here, 952-460-3260. Number's still working. Our phones, our contingency plans in place. You'll be redirected, and we'll make sure that we can address any concerns you have. You can email us at info@securedretirements We'll get that put up here later, but info@Secured Retirements is a good way to reach out to us. Or I'm carrying a office cell phone here. That number is listed there, 952-232-9115. That'll come to me directly. I'm carrying that phone around with me, so we can make sure that I can personally make sure that we're addressing anything. We also have a white paper that we're going to be making available to everybody. The name of that white paper is What to Do in a Down Market. I'd be happy to get that off to you. How do you get that? Give our office a call or email us at info@Secured Retirements. I'd be happy to get you out that white paper on what to do in a down market. With that, we'll be back again next week, Monday. I'm going to plan on doing these each and every week throughout the crisis here, trying to answer questions, concerns, and things that you folks might have. And that's probably the conclusion of the formal presentation. I'm available for questions through text messaging. Hi, Paul. I see that you've said hi here a couple times. If anybody else has any questions, I'll stay on for a moment or two here and see if there's anything that anybody'd like me to address. If not, I hope you have the great rest of your day. Next week. Anybody? Yeah, we'll do next Monday. I've got Dylan here telling me that I should make sure that you all know that we are going to be doing this each and every Monday, right over the noon hour here, Central Time. This week, I happened to come in the office because of the technology. I knew it would work a little bit better. Next week, we'll probably be more at home. We'll see how that all works. But I got Donna and I got Paul. Affect the Social Security on the other side. I don't know if you have but you know what is Social Security? I think Social Security is too big to fail. This has got to be something that the federal government's going to have to protect. I'll tell you, maybe more concerning to me than Social Security, which is backed by the federal government, might be some of those pensions out there. Low interest rate environments are just doing some real damage to some of those pensions. Having mailbox income, money that hits the checkbook each and every month, like a pension, is important. I'm concerned about pensions in the long term out of this, but I think short term, the federal government's going to stay on top of it. I think we're going to see a lot of money going in to make sure that those pensions are going to be safe. And continue to make contributions. Cindy, should you continue to make contributions to a 401k? Absolutely. I think the dollar cost averaging into the market right now will reward folks that have got the ability to do so. So I am a proponent of doing that. I don't think we're going to be down 90% like we were in the Great Depression. I don't think this is going to bring us into the next depression. History shows us, if we go back to a couple slides, that we'll probably be rewarded by staying invested here. But, again, I guess I don't know. Personally, that's what we've been doing. So with that said, I think we're going to wrap everything up. I hope everybody has a wonderful rest of your day. Take advantage of the social distancing here. Reach out to a family member that may be alone right now and see how they're doing, and spend some time with your family and those people that are important to you. That's what all this money is for in the first place, is what it allows you to do, not necessarily what it's currently valued. So it's not about net worth. It's about what that money allows us to do. And we don't forget that here at Secure Retirement Financial. With that said, we'll see you again next Monday at noon, and I hope everybody else has a great rest of your day.